I'd like to briefly talk to you today about the working capital cycle and how important that is to a business. It answers the question of where is the money? Now, you can have a really profitable business according to the P&L statement, but if you're not managing working capital efficiently, you can soon be in problems. Now, let me briefly explain how the cash cycle, the working capital cycle, works. You initially put funds in the business to make a purchase, to create something. So the business makes the purchase from a supplier and it owes that supplier. This is the accounts payable period, the time that it takes from making the purchase to actually paying for the supplier. So the money that you've put into the business has now gone out of the business because you've paid the supplier. Now at this point, you're going to create something, make something in the business. It could be furniture, it could be computer supplies, you could be baking something, whatever it is. At this point, you start to create something and the business then starts to hold inventory. That means there's still cash tied up in the business. The cash is tied up in inventory and goods that you have for sale. You've actually got to sell these goods now. Now, when you do sell the goods and you gain a sale, the money is still not in the business. So the goods are sold, but that is now a period of accounts receivable. You have to wait from the time that you sell the goods to the time that you actually get paid by your customer. This is the accounts receivable period. So when you do collect the goods, this is the only point here where you have the cash back in your business. So it's a very finite period in the whole working capital cycle where you actually have the money that you can take to the bank or you can take out of the business. So this is the cash conversion cycle, and there are some critical measurements in this cash conversion cycle that any business needs to measure to be efficient. Now, the first one is the days sales outstanding. How long are your sales outstanding for? From when you sell goods to when you collect the money. You can calculate this by taking the accounts receivable figure from your accounts, divided by your total sales, multiplied by 365. This will give you the number of days on average that your sales are outstanding. Now, obviously, the quicker that you can collect funds in from customers, the more efficient your working capital is and the quicker you have funds in the bank. The days payable, this is deducted from above. The days payable is the time that it takes you to pay suppliers. Now, the longer you can pay suppliers, the better, because you're holding on to the funds, you're holding on to the working capital. To calculate your days payable outstanding, it's the accounts payable figure from your accounts divided by the cost of goods sold times by 365. This will give you the days payable outstanding. And finally, you can calculate the time that inventory is stuck in your business. How long is inventory held for before it's turned into sales? You can calculate that by the inventory figure that's in your business divided by the cost of the goods sold, the cost of purchasing those raw materials, times by 365. Now, this figure gives you your cash conversion cycle, how quickly you're cycling money into cash in your business. You take the days sales outstanding minus the payables plus the days inventory outstanding. That gives you your cash conversion cycle figure, and the goal is to make that figure as low as possible to really having your working capital working effectively. So I encourage you to really get to understand these numbers. Look at examples for businesses and understand how they're using their working capital. And by working with clients to refine and improve these metrics, you will be able to create value and win big transactions faster.